We got some big news today for Lucid stock investors that's sending the stock price down more than 15% as of this recording. The company announced that it was going to sell more shares of its company, and that's bringing down the valuation. I'm going to go into the details of that stock sale announcement and what it could mean for Lucid stock investors. And I'll also elaborate on why a stock sale causes a stock price to come down. I'll give you the technical details behind that action. So let's get into the details.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so Lucid saying that it's going to sell roughly 262 million shares of its common stock, or in other words, it's going to raise proceeds of about $1.67 billion by selling those shares of common stock. Lucid has granted the underwriter a 30-day option to purchase an additional 39 million shares if the underwriter chooses to do so, meaning if the stock price is higher in the next 30 days, they may choose to exercise the option to buy these additional 39 million shares at the lower price agreed on. As a result of this purchase, the heir expects to maintain its approximate 58.8% ownership of Lucid outstanding stock. Now, this is the Saudi Arabia Public Investment Fund that is investing in Lucid and has made significant investments in Lucid and remains one of its largest shareholders. This investor has incentive to continue investing in Lucid because if they don't and the company doesn't raise the capital, it might go out of business and then its existing investments would be worthless. And so they are likely to continue investing in Lucid until it gets the company into a self-sustaining stage. You might be asking, why is Lucid doing this? Why are they raising capital? Do they need this money? And the answer is yes. The company had $3.9 billion as of June 30th, 2024. That was down from about $4.3 billion on December 31st, 2023. The company has raised billions and billions of dollars from investors, and it has yet to reach a level where it's self-sustaining, meaning it's not losing money on the bottom line. Its net loss totaled $643 million in the most recent 3 months ended June 30th, and its free cash flow was even worse at negative $741 million in the quarter that ended June 30th. So at that pace, if it continued, that would be roughly $3 billion. The $3.9 billion it has on hand would be wiped out in about 5 quarters if it continued at that pace. So it didn't have a very long runway. According to Lucid management, they said on August 5th, they raised an additional $1.5 billion. So this comes after the June 30th report here. So they had an additional $1.5 billion, again with the affiliate of PIF, strengthening its liquidity runway until at least the fourth quarter of 2025. So basically 1 year from now, they had runway until they ran out of money. And so by raising this additional $1.7 billion, according to this pace of free cash flow, negative free cash flow of $741 million, that gives them about 2.5 quarters of additional runway to get themselves closer to when they can be self-sustaining on the bottom line. So now let me address the question of why a stock sale lowers a stock price. And the reasoning is because of the additional shares outstanding. If you have a company that generates $100 in net profit and it has 100 shares, that would mean each share earns $1, right? The earnings per share is $1. But if you have a company that earns net income of $100 and it has 200 shares, then the earnings per share is now 50 cents. So each share is less valuable because it's entitled to less earnings because there's more shares outstanding. There's more to be split. There's more people that are going to earn some of those profits. And so that's why when a company does a stock sale, the stock price comes down because you're splitting up the shares in more pieces. I'll give the pizza example again. If you have a pizza and you're selling the whole pizza, you can sell the whole pizza for $10 because it's a whole pizza. But if you cut that pizza up in slices, you can't sell each slice for $10 because now it's a smaller share of the overall pizza. And so if you're getting a smaller piece, you're going to be willing to pay a lower price. And if you cut it into even smaller pieces, then the price per piece will continue decreasing as you continue cutting it into smaller pieces. That's what happens with the stock sale. A company splits itself up into smaller pieces and it creates more of the pieces outstanding. And so that creates a decrease in the price per piece or the price per share in this instance. But at the same time here, the company is raising capital, so they do get $1.7 billion. And so if they are able to use that $1.7 billion to create more earnings, right, to make more pizza, then it could have the potential impact of being positive for all shareholders in the long run. That remains to be seen. That will happen later. Right now, the initial impact is a decrease in the price. And then if the company utilizes this capital effectively, that could have the impact of increasing the price later on down the road. That remains to be seen, right? So that's why a stock sale usually will lower the stock price to begin with, and then later on it might increase down the line. It doesn't always have the impact of lowering the price. If the company does a stock sale and the sale indicates that the company's using that money for something that's going to be very beneficial, then investors may perceive that as a positive immediately, and the price might go up immediately. And so this isn't like a guarantee thing that the price goes down every time there's a stock sale, but usually that's what happens. And especially when you're in a company that's losing so much money on the bottom line and its prospects in the future are uncertain, the price reaction is typically negative to begin with. Still, the company does have some catalysts coming forward, and those are in the form of new products. The Lucid Gravity SUV is scheduled for the start of production in late 2024, and then they have a mid-sized platform with a lower price that's scheduled for late 2026. So I forecast that Lucid will need to sell more shares or raise additional money, whether it be through stock sales or maybe borrowing money, in order to get itself to the point of that lower priced model. Because I don't think with the SUV alone, that will increase the company's cash flow to being at least neutral or positive. I think the SUV will be a huge help. It might double sales in 2025 for Lucid because SUVs are more popular and higher in demand from consumers than sedans. And the price point of $80,000, I think, is an attractive price point. And Rivian, which is another electric SUV in the United States, has proven that there is considerable demand in the marketplace for these electric SUVs at that price point. Rivian is even more expensive than $80,000, the average selling price. And so these are two catalysts for Lucid stock investors to look forward to hope that these will sell at high enough levels to at least let the company hit further milestones and further progress to allow it to raise capital at better prices, and so get itself to the point where it can produce that mid-sized platform in late 2026, ramp up sales in 2027, and then maybe, this is a big maybe, starting in 2028, the company can be on a sustainable footing, meaning it's not losing so much money on the bottom line. Its cash flow from operations are either zero or slightly positive at that point. And then from that point on, Lucid stock investors can at least feel comfortable that the company doesn't need to go back to investors and raise more money. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.